we could now have our growth panelists to the left. Good. Thank you very much for doing this. Do you want to sort of come down the line from Richard and just briefly introduce yourselves, please?
Yep. So this works. Yep. Cool. So Richard Watts, fund manager at Jupiter, also the co-manager of Chrysalis Investment Trust. So history of managing UK mid and small cap listed equity money, and with Chrysalis we invest in private companies.
And my name is Peter Hewitt. I'm the investment manager of the Columbia Threadneedle Managed Portfolio Trust, which is a fund of investment trusts. It has a growth portfolio and an income portfolio. So I'm right in the middle of all this discount widening just now. Although I hasten to add, our trust does not have any discounts.
So my name is Laura Foll. I co-manage Lowland, Lord Venture and Henderson Opportunities Trust. All of them are UK focused and multi-caps. They go all the way down to AIM and up to the FTSE.
Cool. So I've got a few questions just to sort of start off with, and then, as I say, when you've got something from the audience, please just put your hand up. So the first question I have is, do you think that if you go back to the end of 2021, the growth stocks were overvalued? Let's start with Laura.
Should I kick off? I think in short, I think the answer is yes. And that might not be necessarily what people want to hear, but I think that's the reality of it. If I look at some of, say, the alternative energy names, the Ceres Powers, the ITMs of the world, I think they were pricing in what was in reality a very blue sky scenario. And I think, to be honest, looking back, I think we knew that at the time. We were taking profits. You've got to be very careful because you can convince yourself of these things, but we were taking money out. I think our mistake in hindsight was not taking out more. But it's always very easy to say that in hindsight, sort of when you're in it and they're doing very well, and this was 2020, so a lot of the market was not doing well. You want to stay in the areas that are doing well. I suppose that the question that we have is, do you still want to be in that area? With these smaller companies, if you sell the whole position, chances are you don't buy it back. So you need to, in a way, you need to keep a foothold in the area so that you keep paying attention. Because if we had sold all of the Ceres, all of the ITMs, we do think that these types of companies will go on to be one of them, probably not all of them, some of them we think will go on to be the leaders in the area. And if we had sold out completely, we wouldn't be paying them attention anymore. So I think you do need to keep a foothold in the area. But yes, looking back, I think it would be very hard to argue that those parts of the market were not overvalued. End of 2020, beginning of 2021. You guys disagree?
Well, James, I mean, yes, I think you're right. I think a decade or more of very, very low interest rates, and then COVID, lockdown, and kind of a lot of things to do with technology, digital companies and the likes, proved to be very popular in the stock market. The investment companies that were participating also proved to be very popular. And so you then had kind of an acceleration up towards the second half of 2021. And then, of course, things changed, the first signs of interest rates going up. And then you look back in hindsight, you think, well, my word, how could I possibly have been still holding some of these companies at these ratings? And I always think the end of 2021, Scottish Mortgage, which is a great sort of bellwether, it was 20 billion assets and the performance had been unbelievable. And as David said, James Anderson, absolutely brilliant timing. And that was 15 quid a share. And by the summer of 2022, it was 7. Now, since then, it's kind of been between £6 and £7.50. You can argue whether you like some of the holdings or not, but it's a pretty good bellwether of what's been going on. But I certainly think, and I sold a lot of stocks, Scottish Mortgage in January of 2022, but as Laura was saying, it just wasn't enough. I mean, I should have basically got rid of it completely and a whole series of other trusts. But then you're faced with the problem of, well, do you ever get back in? And the thing about these trusts is that invest in growth companies is that's where you will make multiple times your money over the long term. It will not be in Temple Bar or something like that. And Temple Bar, wonderful trust, don't get me wrong, but you're not going to get 5 7, 9 times your money there. But you might do in some of these other trusts. So it's, yes, I mean, it was too much. And I think actually quite a few people realised that and were selling. But with hindsight, probably not enough.
Yeah, look, I think that's right. I think the reality is the market for growth stocks cracked in Q4 of 2021. You didn't really see it at the headline level. The Nasdaq, was still hitting highs into December of that year. I suppose the second liners, for want of a better term, they probably peaked in September 2021. And I think the reality is, we were in a world back then where monetary policy was extraordinarily loose. Interest rates were basically zero, and people were still chasing the pandemic winners. That's a phrase that's probably used a bit less now, but it was a phrase that everyone was using back in 2020 and 2021. So I think there was sort of exuberance in many valuations, but I think the problem is on the way up, everything kind of a rising tide lifts all boats, and I think it's the same in reverse really, where things have probably gone too far the other way, almost as if investors have abandoned wanting to own many growth companies. And I think that's a real shame. And as Peter said, we're investing in businesses because we think they're very disruptive in nature. And the reality is, that disruption doesn't just go away because growth stocks are out of favour. Many of those businesses have carried on, executing the growth plans, trading well, taking advantage of, massive opportunities to disrupt huge markets and creating value. I'd say that value is not really being reflected today, but you've got to be hopeful that over a longer period of time they'll come through. And I think this concept of trying to identify investments that have the potential to give you, just quite frankly, enormous returns. And that's what we have been trying to do, in Chrysalis. I'd probably also kind of say that, when you kind of look at what's actually going on, in the stock market, the reason that we launched Chrysalis back in 2018 was essentially recognizing the fact that, private companies were staying private for longer, and the ability to access very innovative, very disruptive, fast-growing businesses was just getting less and less and less. That's just got worse, and there's been a lot of research and newspaper articles written on this topic in recent months in particular. Look, if I look at the FTSE 250, I run a mid-cap fund. The benchmark is the FTSE 250 ex-investment trusts. And historically, that always used to be 205 to 250 stocks. So if you excluded the investment trusts, it's about 167 today. And there are less and less listed companies. And I think the environment that, we've kind of collectively created, I suppose, in the investment industry in this country just isn't incentivizing private companies to want to list in the UK.
Do you agree with Richard that I think it's gone too far the other way now, that growth stocks are too cheap?
I think it's clear that there's a valuation discount versus other markets. I mean, it's always harder to say at the smaller company end because there's often not a very direct peer. So whereas with the large companies, you can go Unilever versus Nestle and P&G, and no one can say that's not relevant. It clearly is relevant. It's much harder to say at the smaller company end because it's not like you can go, well, there's a peer for this small cap in the UK versus small cap in Japan. But to give you one example, which I think is relevant, if you look at something like Nanopore, Oxford Nanopore, this is a global market. Nanopore very nearly didn't list here, but there was clearly some arm wringing, and it did. It probably wanted to list on Nasdaq in reality, but anyway, it's here, and it's got a very clear competitor in PacBio in the States, and PacBio trades on a high multiple, materially high multiple, and they're very similar sized companies. Oxford Nanopore hasn't actually operationally put a foot wrong since IPO, and here we are, and it's a long way down from its IPO price. So I think there is a clear, where you can point to examples, I think there's a clear valuation discount here. And the question is how that's corrected. I think unfortunately at the moment, and this goes to what Richard was saying, the way that valuation discount is being closed at the moment is takeovers, and often at prices that frankly are miserly if it comes from PE, and yet they're being voted through, and that is a real source of frustration to a lot of fund managers in the UK. But we feel like we can't, we can vote against, and we are voting against in some cases, but there's not much more than that we can do about it. So, if we're not getting inflows, we're kind of stuck. I see these articles all the time. UK fund managers aren't long term enough. And I think, I agree. But what can I do about it? If we don't have any inflows, there's not much more we can actually do. It's very frustrating.
I mean, I would say a lot of growth stocks are actually quite good value now. They've had huge de-ratings, and in the main, top line revenues, profits, and earnings have probably done pretty well in a slowing economy. But for that to be unlocked, I mean, David was talking about higher for longer, and if it was 4 or 5 years of rates being 5%, 6% ish, then there's no doubt it will be a real headwind, and it'll be uphill into the wind for growth stocks. There'll be some that will still come through, but a lot just will be ignored. And so I think it's quite important that the macro side begins to fall into place, and perhaps by, say, this time next year, there are signs of, perhaps rates coming off. And that being the case, because the stock market is a wonderful discounting mechanism, actually share prices move well ahead of that. So actually you could see growth investing come back quicker and stronger than you think. I mean, I'm not going to predict, I have no idea so interest rates are going. But what you do know is that the sentiment is so adverse that actually when that's probably the right time to be considering in investing, and whether that's in an investment company or individual operational companies, I don't think it really matters. I mean, in the case of investment companies, some of these, you take Cap Technology or Allianz Technology, we've actually been doing quite well. We're actually up quite a bit this year for different reasons. They're both selling at mid-teens discounts, so there's quite a bit of value in there. And I think the other thing I'd just like to say, James, on that, I think there is quite a difference between growth companies that are producing quite significant revenues, earnings, profits. Think of the big tech companies in the US, and those are at perhaps an earlier stage that are just producing revenues but no profits. These are really out of favour just now. And again, David was mentioning the biotech sector. That's classic. And it's still, very out of favour just now.
Do you think actually there were probably some companies that got funded that shouldn't have done when there's sort of easy money conditions?
I mean, it's absolutely the case that many businesses got funded, but frankly, the business models were just terrible. I mean, and didn't really stand up to a great deal of scrutiny. And so I probably shouldn't name these companies, but the reality is, you were seeing lots of these kind of businesses coming through. I mean, certainly from the second half of 2020, I mean, there was an enormous amount of capital that got poured into the private space, through 2020 and 2021. And the simple reality is, when you have that amount of capital pouring into an industry, then, the good proportion of it is going to be allocated poorly. People just chase investments, and it was very difficult to get into many names. It was very competitive, and again, maybe the industry didn't do itself any favors here, but with the advisors and investment banks, almost kind of created an auction, and so to get into these names, wasn't always easy. But so I think the key thing back then was just to maintain your discipline. It was to say, actually, I can't make sense of this. We don't need to kind of deploy our capital. But for many, that proved to be a difficult thing to resist, I suppose. But yes, the reality is, look, a lot of capital going into the industry, and I think businesses never got funded that probably shouldn't have been funded. I think now, though, I mean, I think there's been a big normalization. I think in the last, I suppose, year and a half, or almost 2 years now, where I think that exuberance has come out of the market, and there's been a huge focus here that the funding environment is just dramatically different today than what it was back in 2021. And the mantra that we've had with our investments and the companies and the management teams and the founders is just this kind of focus on driving towards profitability. And naturally that does come at the expense of growth. I mean, you can't expect businesses to carry on growing as quickly when you're asking them to cut costs or just invest maybe at a more moderate pace. And I don't think that's a bad thing. And I think what you'll start to see emerge over the next, I think it's happening now, frankly, but over the next year or so, is that the very good private companies that do have, strong business models that are addressing very large markets, that are disruptive, that are able to grow quickly, the jaws start all, top line, growth and revenue growth comes through, leveraging a cost base that is rising more modestly, and these businesses driving towards profitability, and that kind of creates the potential environment, I say, over the next year or so, that many of these businesses probably will start to IPO. And I think you're seeing it already, certainly in the US, obviously like of Arm and Burke, some of the IPO market feels if it's opening. I don't want to talk too soon. I mean, with the rise in bond yields, who knows? Maybe the market environment will get more challenged in the next 6 months. But I think there's certainly an appetite here for listed investors. They want something new to invest in, frankly. And I think we're kind of ready for it. The IPO market's probably been closed for about 7 quarters, probably pushing on 8 quarters in the UK. Historically, that's a very, very long period of time. Typically, it's 6 to 7 quarters in IPO downturn. So I think there's an appetite to want to invest in new things. The slight problem might be that certainly from a UK perspective, if you look since the Brexit vote, there's been 180 billion of outflows from UK mid and small cap funds. I mean, it's just simply enormous. And, that reflects lots of things. I think your lack of appetite maybe for growth or growth investments, but more appetite to invest in the FTSE 100, given oil prices, commodities, the value of investing theme having a resurgence, and the fact that bond yields are higher, and people allocating money elsewhere. But, I think it's a problem that needs to be solved, I think, to reinvigorate the growth space.
I mean, if I could maybe just chip in, I'm happy to name a business that shouldn't have been funded. If you look at something like Kazoo, our motor retailers, we hold Vertu motors in most of our funds. They were very, very frustrated about the Kazoo IPO evaluation. At the time it was many, many multiples of what they were. And they were making money, and they would say to us, "Well, we can deliver a car. You can buy a car through our website, and we'll deliver it." It's exactly the same as Kazoo. And at the time, their market cap was about 100 million, and Kazoo was 7 billion. And they literally were completely perplexed as to how that was right. And there are many other UK listed businesses that were frustrated at having to compete with companies that weren't making any profit. Whereas they were having their shareholders say, "Look, you need to make this return on capital." And there are other businesses out there with no returns hurdle seemingly at all. So I think it's a very good thing that there is now, a more normal rate of interest. I don't know what the normalized rate is, but anyway, a more normal rate of interest that creates a proper hurdle rate, so that these types of, the next Kazoo won't be funded like that. And I think that's actually a really positive thing for larger businesses that are trying to make a proper rate of return. So I think that, actually, I think that discipline, we talk a lot about the negatives of a rising interest rate, but I think that discipline is actually a really good thing for the market.
It's been a sort of fairly painful adjustment, there's the higher rates, but it does feel to me as though we're closer to the end of that. Do you need falling rates to make growth stocks go up, or will just the acceptance that they've stopped going up help?
To be totally honest, when we've looked at the correlation, because I think everyone that works in small and mid cap is trying to work out what the catalyst is. That's probably my most asked question from investors. What is the catalyst? And if I could tell you, I probably wouldn't be here. But so we've gone back and done the correlation, and rates doesn't seem to be it. The only one we can find is PMIs. So if you see the PMI data pick up, which to me feels common sense, as in these are businesses that are, for the most part, more domestic, more cyclical, i.e. you need to have the domestic economy doing a bit better for them to outperform. And clearly we're not there yet. The PMI data is pretty weak in the UK, and if anything, it seems to be getting slightly worse. So maybe we're not there at the moment, but it makes sense to me that these more domestic businesses need a bit more confidence in the domestic economy, and it just feels like it's just not quite there at the moment.
That's a tough one, James. I mean, I think you see, I mean, the discounts of investment trusts is a wonderful sort of bellwether. And, they were got to, the average sector discount was 2 at the beginning of last year, and it came into the mid to high teens. It's kind of stayed around about that for the last few months. Listen, it could still go a bit further, but my feeling is that there is signs of it stabilizing. I don't know. You need to speak to various stockbrokers as to quite the flows of business. And I don't think there's a lot of selling going on now. What you definitely know is there's a buyer strike. There's next to no buying. So the upshot is discounts are in the average discounts 16, 17, 18. Move around a little from there, but maybe so maybe the worst of it is over. I think the other thing to mention on top of discounts and kind of future growth investing, future growth stroke active investing is simply both Laura and Richard have touched on it, is for active fund managers to outperform. And I see loads of active fund managers, some of them really quite talented. And if you look at their records just now, you'll see kind of the 3 months, 6 months, 1 year, oh gosh, 3 years, in a lot of cases 5 years. They're now well off the pace. They're behind the benchmark. You think, God almighty, this is an open goal for the ETF market. And it's because the extent of the underperformance has been, the magnitude been so great the past 18 months that it's pulled the rug out from longer term numbers. I mean, maybe 10-year numbers are okay, but actually shorter than that. And it's not just in UK equities, it's across the board in different markets, different sectors, healthcare, the US, Europe, it's all the same. And so if you kind of, so we've got to see mid and small caps do a bit better, or the big companies do less well, and that could well happen at some stage, and probably will, given what's happening with valuations. But until that does happen, this is going to persist. But when it finally peters out, and as Richard was saying, the selling in particular in the outflows in the UK has been massive. I don't think it needs huge amounts of inflows. It just needs the outflows to start petering out. And then you're in a situation where you've got a series of probably reasonable managed funds selling at 12, 15, 17, maybe even 20% discounts, lobbing a bit of gearing, and that's when you get great performance. You think to yourself, oh my word, how is this? Oh, it's like a new, and because you know it's going to happen. I don't know when. I hope maybe next year, but that's the sort of cocktail that we're looking for.
Yeah, I agree with Laura. I think, you know, when we've looked at certain sectors in the UK market over time, correlated against interest rates, there isn't much of a correlation. And I think the simple explanation is, I mean, what's really driving markets is the outlook for economic growth. And I think what we probably need to see, so I don't think we need to see interest rates falling for people to switch back on to growth investing. I think we just need to see confidence increase and confidence improve. And I kind of find it slightly amazing, really, but we've probably spent the last 2 years where the narrative that you've read in newspapers, particularly in this country, has been one about just how bad the UK economy has been. You know, it's been the worst performer of the G7 economy since the pandemic. It's got the highest level of inflation. It has all of these structural challenges. And of course, we've seen recently with the ONS, revisions that actually the UK economy isn't the worst performing economy in the G7. And if you actually look at the data, between 2010 and 2019, the UK economy was the second fastest growing economy behind the US. And actually, since 2019, it's not far behind, right? So it's right up there. So if you look at the outlook, I think the thing that surprised me is when you went through the pandemic, there were a lot of savings that were being built up in the economy. Obviously, as people were just changing spending habits. Before the pandemic, the amount of excess of surplus capital in the banking system, so surplus deposits, was about 500 billion. And that peaked at about £1 trillion. I say peaked, but the narrative, it peaked at £1 trillion. The reality is those savings or excess savings have continued to grow. So if you look at the UK economy, I mean, the savings ratio for the last 3, 4, 5 quarters has been 8 to 9%. I mean, this is just nuts. 8 to 9% savings rate in a world where inflation has been almost double digit for a long period of that time. And it tells you that within the economy, there are lots of people that have lots of money still. Now, there are definitely people on the other side who are more exposed to what's going on with mortgage rates, etc., who have less money in their pocket. But in aggregate, there are more savings in the UK economy today than there probably ever have been. And we're heading to a world where the level of inflation is falling. You've got real growth in wages. The employment market is strong. And yet pretty much every economist, if you look at the consensus, has a very, very low level of GDP growth in the forecast for 2024. And my view is we're going to comfortably beat it in this country. And so I look at it thinking interest rates probably aren't coming down in the UK, and doesn't mean that they necessarily go up, but I think this higher for longer, I think is here to stay. And that has, I think potentially sort of profound implications really, because the psychology is one where everyone is very, very negative. And I think the emerging reality is going to be over the next 12 months, actually things are a lot better than people think. Good,
it's positive. So questions from the floor. Got one down here. Do you want to switch your mic on, please?
Particularly probably orientated at Richard, but do you think the public markets are a good place for listed VCs? I suppose what I'm trying to get at here is that anything that's got kind of, stock public markets and their ability to be able to invest in earlier stage, and in your case, kind of pre-IPO stuff.
Yeah.
It's a brutal environment, and they quite often get the numbers horribly wrong. And I've talked to one VC who's listed, and he just said, I wish I'd never, ever gone near the London Stock Exchange. Do you think it's the right place, or should it stay private?
Yeah, I think why we wanted to launch Chrysalis as an investment trust, and it was almost, the what do you call it, high level sort of view of it, but it was almost like the democratization of allowing anyone to invest in private companies. And I thought that was a pretty worthy goal to try and aim for, was to say, well, there was a part of the market where most people were locked out of participating in. And I felt that we were able to kind of, through what we were doing in the listed funds, give investors access to that part of the market. And do we regret it? I mean, I'm not saying the last 2 years have been particularly easy. I think we've had, there's been a lot of commentary about Chrysalis in the press. But I think the underlying rationale for Chrysalis is more valid today than it's ever been, frankly, given what's going on in the listed world. So I think, look, we're working very hard to try and educate people as to what actually we are doing and what the opportunity is. And I just accept that, at points in time, maybe the message doesn't get through as well as we want it to. I don't think it necessarily undermines, the reason to be listed, because I think the overall, the overriding rationale, I think, is a very good one. And I think we just probably need to try and, educate people in the sense that, you look at the Mansion House Compact, try to get more pension money, invested in, unlisted assets, etc. So I think there's definitely a need and a requirement for what we are doing. And I think it's up to us to deliver, frankly. If our underlying investment companies and investments perform well, things can radically change. And the thing I kind of look at, years ago, we still are, we're invested in 3A in our other funds. And that for me was always something I think to aim for, in the sense of just making things very simple for people to understand. You look at 3A, and one of the questions we get at Chrysalis is concentration risk. We've got some assets that are 15, 20% of the fund. And I'm thinking, well, no one complains about 3A, right? 60% of their NAV in one asset. And why? Because it's a very, very good business, Action. It's growing very, very strongly. It's very profitable. But critically, I think people understand that they could realize that asset at any point in time, right? And that's, Chrysalis is not quite there. But I think the reality is when we get there, so i.e. if we start having, maybe Klarna, there's a lot of speculation on Klarna, maybe IPOing, but if we start to get these assets that drive towards profitability, are growing very, very quickly, that we can actually tell people this is the PE multiple of Chrysalis. And you can actually put Chrysalis on a PE, and you can look at Chrysalis's growth rate on a PE, and maybe we start to get cash returns on these investments. But fundamentally, can we actually realize them? And I think once we get to that point, I think our discount will unwind. And so that's what we're aiming for, and that's the message that we kind of been telling people. But I think if we get there, I think that will be, I think that will make a transformational difference, right, to people's appetite to want to invest in Chrysalis as well.
Cool, thank you. Anything else? Questions from the online audience?
Yeah, we have a few questions coming through online. One of which is, do you see merit in the business AI?
Can I go? Sorry. Look, it's like anything, isn't it? I do, right? I think fundamentally, AI is going to be transformational to how many businesses, operate in terms of, productivity and efficiency savings, etc. And there are lots of businesses that we've invested, certainly private ones, that are doing this today, and it's yielding significant cost savings in their business. So, automating manual tasks that will take, tens of employees hours a day to do, and get a machine, to do that really, really quickly. So I think yes, but it's like anything, right? In the early stages of the hype that this is going to be the next big thing, there are going to be a bunch of stocks or companies that end up trading on valuation multiples that are not sustainable. But I think over time, again, I think technology is a massive deflationary force, and I think we've gone through this technology for the last 15 years, basically, with the onset of the internet, etc., where that technology change is like the industrial revolution. I mean, I fundamentally believe it, and so I think over the next 5 to 10 years, you just see more and more applications that are powered by AI, and that's going to lead to huge productivity gains.
Does that apply to your stocks too, Laura?
I may be slightly more skeptical in the short term, and the reason I say that is I look at things like, please tell me if this is wrong, because it's not my area, but if I look at things like gene sequencing, you have the human genome fully sequenced whenever it was 2000, and we're only now 20 years later really starting to use the application of it. You would have been right in that it is transformational, but it's taken a hell of a long time. And I'm not saying it would take 20 years, because I think tech's moved on since then, but I would guess this is more of a 5 to 10 year story, and we're seeing some companies re-rate very strongly instantly. And I'm just a bit wary, but I want to take a bit of a step back, because I think some prejudgments are being made for certain companies about it destroying their business models, etc. And I think it will take time to see who are the winners and losers of it.
Cool.
What do you make of the valuation gap between the US and UK markets?
Shall I say that? I mean, it's there. It's irritating. In some cases, I think it's justified and it's almost self-fulfilling. And what I mean by that is there's a sense in the UK that they don't have the depth of capital markets that we have in the US. And that leads to a valuation discount that then ends up being right because they don't have the capital depth. So we saw this with a company called Blue Prism, which has got taken over. It was robotic process automation software, basically bots that, early AI use where they'd watch what a human did and then copy it basically. But it was at a valuation discount to its US peers because it couldn't raise the money here that the US companies did. And then it got taken over at a discount for that reason. So it almost does become self-fulfilling. So there is a valuation discount. Sometimes it can become justified. And frustratingly, takeovers are what seem to be bridging the gap at the moment.
Yeah, I'd say as well. I mean, the UK is on what appeared 10. S&P like 19. And if you look at that valuation gap, it's just got wider and wider and wider over the last 5-10 years. And the reality is, though, a lot of it reflects sector composition. I mean, I think even adjusting for the sector composition, the US is more expensive because of the depth of liquidity, or maybe the relative illiquidity of everything else, right outside the US. But someone asked me a question today. So, how much of the UK market is tech? Obviously, I knew the answer was pretty low when I said 2%. I said, well, it was wrong. It's like 1%. It's just pathetic. When you look at America, I think it's like 25 or whatever the figure is in America. So, you look at it, and I think I think everyone knows this. I mean, the reality is the UK market is populated by older world type of companies, and not necessarily the ones that are, like technology driven and maybe are going to be the growth engines of the next, 20, 30, 40 years. So, yeah, and again, it comes back to the same thing, though, doesn't it? It's about revitalising, the UK market so that it's seen as a destination for these very innovative private companies to want to list in this country. So I've been fully on board really with the various reviews and Higgs review, etc., and the Treasury initiatives to try and reinvigorate the UK market. And I just hope it's not too late.
You've got a global portfolio, Peter. So what's your view on it?
Well, my feeling is there's always been, the US has traded at a premium, and I suppose in the long run, corporate earnings growth has been a bit better, but the magnitude of it is enormous now. Now, a lot of it is, 30% of America is technology, and they're the ones that are real. If you excluded some of the big mega techs in the US. I mean, Microsoft has gone from roughly 20 times earnings to 30 this year on the back of artificial intelligence, because it does participate there, and it will be the initial beneficiaries will be them and Facebook or Meta. And if you took that out, you would find that premium came back quite substantially. But still, you compare Exxon with Shell, Procter & Gamble with Unilever, Philip Morris with BA Tobacco. They're all at quite sizable premiums. And so I won't get too hung up about premium. I think the magnitude of it is huge. And I don't see that in the very short term coming around. But it will. And as Richard said, you've got companies in the UK which are thoroughly unwell. I mean, the 250 index, which I know you mainly invest in, if you actually, I mean, and people talk about how badly the UK has done, or ever, certainly since the Brexit referendum. If you actually looked at the 250 index, it's probably not far behind the NASDAQ on a 15 or 20-year view. It probably is a bit over the last couple of years, but it's still been a great, and that's where the growth stocks, listed growth stocks in the UK reside. So I mean, I think we need to see a bit of recovery there, and I'm going to say this, I think the 250 is probably maybe only slightly above that, maybe 11 times earnings. In other words, it's really at one end of the valuation spectrum. So, I mean, that's where some of the really interesting value resides.
Cool. One more?
There we go. How do we think growth investors navigate the wild swings in sentiment that we're seeing at the moment, and we have over the last few years?
Shall I go very briefly? I think there is an opportunity in some cases. So what do I mean by that? I was talking to our salesperson on the way up. I think that you are starting to see some rights issues being talked about, and people are getting very emotional. I'm not telling you anything you shouldn't. You just need to look at the statements of some companies, and they say they're looking at financing options. We all know what that means. People are getting quite emotional in the market. People have had a lot of people in small and mid cap have had a very tough time. They've seen outflows. When they see a company talking about a rights issue, the instinct is they'll move on. And that is throwing up, I think, some quite interesting opportunities for those that are willing, that are still here, that are willing to do the work. If I look back to the financial crisis, it was some emergency rights issues that went on to be brilliant performance over the next 10 years. And I think we're coming up to that period now. We've had difficult end markets. Some companies have got slightly too much debt. I think for those that are willing to sort of step in, there could be some really interesting opportunities thrown up at a time where I think people are just getting, in some cases, a bit emotional because they've had a tough time. So, sometimes you want to be the person that sort of steps in and help those companies that are good long-term companies, but have just got themselves in a slightly sticky short-term situation. So I think there will be some opportunities being thrown up.
I would say it's a lot of it's about perspective and when you hope. Are you genuinely a long-term investor? Because I feel that we're probably, if we're not at the bottom, we're towards the bottom of where values will go. I'm not suggesting there's a sharp V-turn, quite far from it. But I think if you genuinely have not even a 10-year view, maybe a 5-year view, maybe even a 3-year view, then starting investing in this area of the market now is probably a good plan. I mean, I think really that the next quarter, maybe the next 6 months could be really quite volatile. But actually, if you have your eye on the horizon, then you'll pick up some great bargains now in a variety of different investment trusts, but actually operational companies as well.
Yeah, I'm pretty sure. I think perspective is probably the right word, really, where I think if you're operating in a listed world where you're just looking at your share prices every single day, I mean, it's a lot more gut-wrenching, because you're just getting measured every single day, you can see it. Whereas I think, if you're just purely in the private market, actually, I mean, it's far less gut-wrenching. I mean, it's just much more focused long-term. So I suspect private investors that are not really exposed to what's going on in the listed market from day to day are probably just, head down, get on with the job. And again, coming back to Peter's comment there about being a good time to sort of, start to kind of invest in growth stocks. But the reality is private, you can get some fantastic deals, right? You can get, you know, good structure into these deals. You can get, you know, 1.5 to 2 times liquidation preference on lower valuations. I mean, the ability to deploy capital and, you know, get better returns over a longer term view is much higher today than it's probably ever been in the private market, probably for the last 6, 7, 8 years. Yet no one's to do it, which is, again, you know, speaks as a sentiment thing.
Great. Thank you.